One whale just bought more gold than 85 countries combined, and almost nobody is talking about it. That alone should make you uncomfortable. Because if this were normal, if this were harmless, if this were just another headline, it would be everywhere. It would be on every financial channel, every newspaper, every expert panel telling you what it means and why it doesn't matter. But it isn't. Gold just hit $5,600. Not for the year, not over a decade. In one single month, up 30% in January alone. Silver didn't just move, it detonated. $120 per ounce, 65% in 30 days. That's not volatility, that's a signal. That's capital moving with urgency. That's money that knows something you don't yet. And while you're scrolling, while you're waiting for permission, while you're hoping someone on television will explain what's happening in simple terms, they are not waiting. They are not hoping. They are not asking for approval. They are accumulating every single day, quietly, systematically, relentlessly. 140 tons of physical gold, $24 billion, not paper contracts, not ETFs, real metal, sitting behind steel doors in a nuclear bunker carved into the Swiss Alps. Doors designed to survive World War II. Doors built for a world where nothing works the way it's supposed to anymore. Most people will never even know this exists. The mainstream financial media will never walk you through it. Your bank will never bring it up, because what's happening right now threatens the very system they profit from. But by the time you finish this series, you'll understand exactly who this whale is, why they're hoarding gold like the financial system is living on borrowed time, and why this isn't just about one player. There's a second whale, bigger, older, more powerful, accumulating thousands of tons of gold while building an entirely new system to replace the US dollar itself. And once you see both of them moving in the same direction, you won't be able to unsee it. Let's start with the numbers, because numbers don't lie and they don't care about opinions. Gold finished last year up 65%, best year since 1979. That alone should have been a warning, but this year barely started and gold is already up another 30%. $10,000 placed into gold on January 1st quietly became $13,000 without a single decision, without leverage, without risk-taking behavior, just ownership. But gold is the slow one. Silver is where things stop making sense. Silver finished last year up 150%. And now January alone added another 65% on top. Silver didn't just break its old record of $49. That record stood untouched for 45 years. Silver didn't test it. It obliterated it, more than doubled it. And it's still moving. This didn't happen because millions of small investors suddenly woke up at the same time. This isn't Reddit. This isn't TikTok hype. This is coordinated, sustained buying at a scale that makes most countries look irrelevant. And that's the part that should change how you see everything. There are 195 countries in the world. Only 106 of them own any gold at all. 89 nations have nothing, empty vaults, no hedge, no backstop. And here's where it gets uncomfortable. Some of the wealthiest nations on Earth chose to sell their gold. Canada has zero, not 1 bar, not 1 ounce. 4th largest gold producer in the world. Home to some of the biggest mining companies on the planet. 0 reserves. Norway sold all 37 tons it had. Gone. Australia produces enormous amounts of gold, but keeps almost none. New Zealand has nothing. These countries looked at the United States and said, "We trust your paper." They traded permanence for promises. And while they were doing that, someone else was buying. Quietly, aggressively. This first whale now owns more gold than Greece, more than Qatar, more than Australia, more than Belgium, the Philippines, Finland, Bolivia, combined. More than 85 countries. Ranked among the top 30 gold holders in the world, sitting at the same table as sovereign nations. And they're not slowing down. They're buying every single month. Billions of dollars worth. And this is where most people finally ask the right question. Who? The answer surprises almost everyone the first time they hear it. The whale is called Tether, the company behind USDT, a digital dollar used by hundreds of millions of people worldwide. $187 billion in circulation. That makes Tether larger than most banks and more powerful than most countries. And this company is stockpiling physical gold like the end game is already in motion. This isn't speculation. This is public information. Documented, verified, ignored. Now ask yourself the question that actually matters. Why? Why would a company whose product is a digital dollar be buying gold like this? The CEO said something in an interview that should have been front page news everywhere. He said they are becoming one of the biggest gold central banks in the world. Not gold holders, not investors. A gold central bank. He openly stated that geopolitical rivals of the United States will launch a gold-backed alternative to the dollar. And when that happens, Tether wants to be the central bank of that system. That's not an internet conspiracy. That's a billionaire explaining his strategy in public. And here's where the tone changes. Because when someone prepares like this, they're not reacting to noise. They're reacting to inevitability. And they're not alone. Because while Tether was filling a nuclear bunker in Switzerland with gold, a second whale was moving on a scale that makes Tether look small. This one holds over 6,000 tons of gold, over $500 billion worth. And they're not just hoarding it, they're using it, building with it, designing a system that removes the dollar entirely. The second whale is BRICS: Brazil, Russia, India, China, South Africa. Plus, new members joining every year, together nearly half the world's population, over a third of global GDP, more than half of global oil production. Between 2020 and 2024, BRICS central banks bought more than half of all the gold purchased on Earth. China alone officially holds over 2,200 tons, Russia over 2,300, India closing in on 900. And those are just the numbers they admit to. Now think about what that means. Two massive forces, one private, one sovereign, both racing toward the same asset, both preparing for the same future. A future where trust in paper fades and hard assets matter again. And that future isn't theoretical. It's already being built. On October 31st, 2025, BRICS launched the first version of a new trade settlement system, 40% backed by physical gold, 60% backed by member currencies, a system designed to function without US dollars at all. And here's the part most people still don't understand. This isn't coming. It's here. Russia and China already conduct almost all their trade without dollars, no headlines, no emergency alerts, just a quiet shift beneath the surface. And when you connect that with what Tether's CEO openly admitted, the picture becomes clear. These whales aren't competing, they're converging, they see the same endgame, and they're positioning themselves before everyone else wakes up. And that brings us to the part most people dismiss, silver. Because gold feels serious, silver feels secondary. And that mistake has been repeated in every cycle in history. Silver doesn't follow gold, it outperforms it every time. Because silver isn't just money, it's infrastructure, it's energy, it's technology. And when systems change, silver moves first and fastest. And that's where this story is going next. Because once you understand why silver is behaving the way it is, and why its supply situation is more fragile than almost anyone realizes, the rest of this starts to feel less like speculation and more like inevitability. And this is where silver stops being a side character and starts looking like the pressure point of the entire system. Because silver is not just reacting to fear or currency debasement the way gold does. Silver is being pulled from two directions at the same time, and that's what makes this moment so dangerous and so explosive. Gold is hoarded, silver is consumed, and when something is both money and fuel, shortages don't announce themselves politely, they arrive violently. Most people still think silver is just cheaper gold. Something you buy because you can't afford the yellow metal. That misunderstanding is exactly why these moves catch people off guard every single cycle. Silver does not behave like gold. It never has. When gold rises because of monetary stress, silver rises because of monetary stress and real-world necessity. Solar panels don't care about central bank policy. Electric vehicles don't care about interest rates. Data centers don't care about currency debates. They need silver physically, constantly, in growing quantities. In 2025, more than a quarter of all silver mined globally went straight into solar energy alone. Not jewelry, not coins, not bars, solar. One panel uses a small amount, but when you install hundreds of millions of panels per year, small amounts become massive drains. Electric vehicles use 3 times more silver than gasoline cars. AI data centers, the backbone of the digital economy everyone keeps talking about, require enormous electrical conductivity. Silver has the highest conductivity of any element on Earth. There is no substitute. Copper is cheaper, but it cannot do the same job at the same scale. Aluminum can't either. Silver is irreplaceable in these applications. Now combine that with the supply side, because this is where things get truly uncomfortable. Silver mine production has been declining for more than a decade, not fluctuating. Declining. Silver isn't mined the way gold is. Most silver is a byproduct of other metals like copper, lead, and zinc. That means even if silver prices double, miners don't suddenly double silver output unless those other metals also make economic sense. Supply cannot respond quickly. It's rigid. And for the 5th consecutive year, demand exceeded supply. Not on paper. In reality, metal leaving the ground slower than it's being consumed. Here's the part that almost nobody knows. And when people hear it, they think it has to be wrong. There is less investable silver above ground than gold. Read that again slowly. Less silver than gold. Gold feels rare because it's expensive. Silver feels abundant because it's cheaper. But price and availability are not the same thing. Gold gets stored, recycled, passed down. Nearly every ounce of gold ever mined still exists in some form. Silver gets used up, destroyed, scattered in landfills, devices, circuitry too small and too expensive to recover, gone forever. Estimates vary, but total investable silver above ground is somewhere between 1 and 2 billion ounces. Gold, roughly 6 billion ounces. That means there may be 3 to 6 times more accessible gold than silver, yet silver trades at a tiny fraction of gold's price. That disconnect cannot persist forever. It never has. And when it corrects, it doesn't do so gently. Then, in December 2025, China quietly dropped a bombshell. Export restrictions on silver, no dramatic speech, no global press conference, just policy. And suddenly, one of the largest suppliers of refined silver tightened the valve. Elon Musk noticed. He tweeted about it. When someone building electric cars, batteries, rockets, and AI infrastructure publicly says, this is not good, that's not hype. That's concern from the supply chain itself. Now zoom out. Gold screaming higher, silver going vertical. Central banks hoarding metal, 2 massive whales positioning themselves for a post-dollar world. And meanwhile, the dollar itself just experienced its worst decline since 1973. That year should ring alarm bells if you know your history. That was the year the United States officially ended the gold standard. The year the dollar stopped being a claim on something real and became pure confidence. For 50 years, the world accepted it, traded with it, stored value in it, built systems around it. That confidence is now cracking. The dollar has fallen more than 10% against major currencies in 6 months. Foreign governments are reducing treasury holdings. The Federal Reserve is under political attack in ways we haven't seen in decades. Its independence, the foundation of modern monetary trust, is being questioned publicly. When trust erodes, capital doesn't wait for confirmation. It runs. And where does it run? It runs to what has survived every collapse, every reset, every regime change for 5,000 years. Gold, silver, hard assets that cannot be printed, paused, frozen, or sanctioned. The last time conditions looked like this, in the late 1970s, gold went from $35 to over $800, a 23-fold increase. People who positioned themselves early didn't just protect wealth, they created generational wealth. People who ignored it watched their purchasing power evaporate slowly, painfully, year after year. And here's the psychological trap most people fall into. They think, I'll act once it's obvious. But by the time it's obvious, the easy gains are gone. The metal is harder to get. Premiums explode. Availability disappears. This is how every cycle works. The quiet accumulation phase comes first. That's where we are now. The explosive recognition phase comes later. That's when people panic. And this is why what the whales are doing matters so much. They're not chasing price. They're positioning before price finishes adjusting. They're thinking in systems, not charts. Tether isn't buying gold because it thinks gold might go up next quarter. BRICS isn't building a gold-backed trade unit because it wants a headline. These are structural moves, long-term moves. Moves that assume the current system does not survive intact. And that brings us to the predictions, because at some point, analysis has to step into accountability. You can talk theory forever, but markets don't care about explanations. They care about outcomes. And the conditions right now point toward outcomes that most people are not emotionally prepared for. Gold breaking 6,000 is not a bold call in this environment. It's almost mechanical. Central bank buying alone is running at roughly 60 tons per month. BRICS nations are accelerating purchases ahead of their next summit. Tether is adding several tons monthly on its own. Every dip is being absorbed within hours. Not days, hours. That's not speculative behavior. That's accumulation. Silver at 150 sounds extreme until you understand how small the silver market actually is. It doesn't take trillions of dollars to move silver. It takes a fraction of that. When investment demand collides with industrial necessity in a market, this thin, price moves don't stair-step. They gap. And then there's the geopolitical layer. At least one more major economy announcing significant gold purchases isn't a guess. It's a pattern. Countries watch each other. No one wants to be last. No one wants to be holding only paper when alternatives are being built in real time. This is how momentum forms at the sovereign level. Now imagine 3 possible paths forward. Not predictions, scenarios. The first is the slow bleed. Gold and silver keep rising steadily. 10% here, 15% there. No crisis headline. Just quiet erosion of purchasing power. The most dangerous scenario because it doesn't feel like an emergency until years have passed. The second is the break. Something snaps. A banking crisis, a currency shock, a geopolitical escalation. Confidence collapses fast. Capital floods into metals at once. Supply disappears. Prices overshoot violently. People who waited find there's nothing left to buy. The third is the fake out. A temporary policy shift stabilizes the dollar. Metals correct hard. Weak hands sell. Then the underlying problems resurface and the move resumes even stronger. This is the scenario that hurts the most emotionally and rewards the most intellectually. And all 3 share one thing in common. The long-term direction doesn't change because the forces driving this aren't emotional. They're mathematical, structural, systemic. And that's the part most people still resist. They want reassurance. They want normalcy. They want to believe this is just another cycle that resolves itself quietly. But the people with the most information, the most capital, and the longest time horizons are behaving as if something fundamental is shifting. And once you see that, the question stops being, is this real? And becomes, what do I do with this awareness? And that's where this story goes next. And this is the moment where most people feel a kind of quiet resistance inside themselves. Not disagreement, but discomfort. Because once you reach this point, you can't unsee what's happening, and awareness creates responsibility. It's much easier to dismiss a headline than it is to sit with the implications of a pattern that's been building for years. That's why the system relies on distraction, not deception. Distraction. If people are busy enough, entertained enough, stressed enough about daily survival, they don't ask the deeper questions. Here's one of those questions. If gold and silver are relics, if they're outdated, if they don't generate yield, why are the largest players in the world moving into them now, at the fastest pace in modern history? Why are central banks net buyers of gold for 14 consecutive years? Why is this happening at the same time that trust in sovereign debt, fiat currencies, and financial institutions is eroding? These things are not independent. They are connected. Paper systems function on confidence, not truth. Confidence. As long as everyone believes the promises will be honored tomorrow, the system holds. But once doubt creeps in, once alternatives emerge, confidence doesn't fade linearly, it snaps. And when it snaps, the migration to hard assets doesn't ask for permission. This is where most people misunderstand the role of gold and silver. They think it's about making money. It's not. It's about preserving optionality. Gold doesn't promise growth. It promises continuity. Silver doesn't promise stability. It promises leverage to disruption. In periods of calm, these metals feel boring. In periods of transition, they feel inevitable. Now let's talk about the US dollar, because everything in this story revolves around it, whether people admit it or not. The dollar isn't collapsing tomorrow. That's not how reserve currencies die. They fade, they get questioned, they get bypassed. One trade deal at a time, one settlement system at a time, one bilateral agreement at a time. That's exactly what's happening right now. Countries aren't dumping the dollar out of anger. They're reducing dependence out of prudence. The moment you can trade oil, gas, technology, or food without touching dollars, the dollar loses its monopoly premium. Demand softens. And when demand softens for a currency backed by debt and confidence, something else has to absorb the excess. Historically, that something else has always been gold. This is why what BRICS is building matters so much. It's not about replacing the dollar overnight. It's about offering an alternative. Systems don't die when they're attacked. They die when they're ignored. And once a parallel system exists, even if it's imperfect, even if it's limited, it changes behavior. Behavior change precedes price change. Always. Now think about Tether again in that context. A private company issuing digital dollars, quietly building gold reserves, positioning itself as a neutral bridge between old systems and new ones. That's not an accident. That's strategic. If sovereign systems fragment, liquidity doesn't disappear. It reroutes. Whoever controls trusted settlement mechanisms in that environment becomes incredibly powerful. This is why it's dangerous to think of these moves as speculative bets. They're insurance policies written by entities with access to information most people never see. They don't need certainty. They need probability. And the probabilities right now strongly favor a world where paper promises lose relative value to tangible assets. At this point, people usually ask the same question, phrased in different ways. What does this mean for me? And that's where the answer gets uncomfortable again, because it depends on how exposed you are to systems that assume stability. Savings accounts, pensions, long-duration bonds, fixed incomes denominated entirely in fiat. These instruments work beautifully when purchasing power is stable. They quietly fail when it isn't. The danger isn't that money disappears. The danger is that it stays numerically intact while buying less and less of real life. Housing, energy, food, healthcare, education. This is how wealth transfers happen. Not through confiscation, through dilution, through time. That's why the phrase biggest wealth transfer in modern history isn't exaggeration. It's descriptive. Capital is moving away from abstractions and toward things that cannot be diluted. This transfer doesn't announce itself with sirens. It happens while people are busy arguing about politics, personalities, and short-term market noise. And here's the brutal truth. You don't need to be perfect to navigate this. You just need to not be completely unaware. The difference between those who come out of transitions like this intact and those who don't usually comes down to one thing. Did they see it early enough to have choices? Choice disappears under pressure. When systems strain, options narrow. Premiums rise, liquidity dries up, governments intervene, rules change. That's when people realized they were relying on assumptions, not guarantees. Now consider how small the physical precious metals market actually is. Not ETFs, not derivatives, physical. If even a small percentage of global financial assets tried to move into gold and silver at the same time, the price response would be nonlinear, explosive. There simply isn't enough metal. That's not opinion, that's inventory math. And that's why timing matters less than positioning. This isn't about catching a top or bottom, it's about exposure, about understanding what you actually own, about asking whether your savings represent claims on systems or claims on reality. At this stage, skepticism is healthy, blind belief is dangerous, but dismissal without investigation is worse. Everything discussed here is verifiable. Public statements, official data, trade flows, central bank balance sheets. This isn't secret knowledge, it's ignored knowledge, and that's intentional. Because widespread understanding would accelerate the very process the system is trying to manage slowly. Stability depends on gradualism. Awareness disrupts gradualism. And now we arrive at the psychological fork in the road. One path says, this is too big, too complex, someone will handle it. That path leads to passivity. The other path says, I don't need certainty, I need preparation. That path leads to agency. Preparation doesn't mean panic. It doesn't mean all in bets or reckless behavior. It means alignment. It means making sure at least part of your world is not entirely dependent on promises. Because when the music stops, and it always does eventually, the question won't be who predicted it perfectly. The question will be who had a seat when everyone realized there weren't enough chairs. And that brings us to the final layer of this story. Not the whales, not the medals, but the choice in front of you right now while there's still time to make it calmly. Because in the end, this story isn't really about gold or silver or even whales. Those are just symbols. What it's actually about is positioning before consensus. Every major shift in history looks obvious in hindsight and impossible in real time. People don't miss transitions because the signs weren't there. They miss them because the signs didn't feel urgent until the moment urgency removed their choices. Think of the global financial system like a game of musical chairs that's been running for decades. The music has been playing since the early 70s. Every cycle, every crisis, every bailout just turned the volume down slightly, but the music never stopped. People danced, they worked, they saved. They trusted that when the song ended, there would be a chair waiting for them. And for a long time, there was. But quietly, the number of chairs started shrinking. Not all at once. One by one. Gold sold. Reserves diversified. Trade routes rerouted. Settlement systems rebuilt. Nothing dramatic enough to interrupt daily life. Nothing loud enough to trend on social media. Just steady, structural change. The smart players noticed first. They didn't panic. They didn't announce it. They simply stopped dancing. They started grabbing chairs. Tether grabbed 140 tons worth. Every week, more metal disappearing behind steel doors designed for a world that expects shocks, not stability. Bricks grabbed over 6,000 tons, not to speculate, but to anchor a parallel system. Central banks across the globe followed quietly, month after month, year after year. And most people kept dancing. Not because they were foolish, but because the system trained them to. Because normalcy bias is powerful. Because admitting that something foundational might change feels destabilizing. Because hope is easier than preparation. Here's the part that matters most. You don't need to predict the exact moment the music stops. You don't need to guess which scenario plays out. Slow erosion, sudden break, violent correction followed by acceleration. All of them lead to the same realization. When confidence shifts, access matters more than price. Availability matters more than charts. Ownership matters more than promises. This is why people who wait for absolute clarity usually act too late. Clarity arrives when the transition is already underway, when premiums have exploded, when supply is constrained, when rules change overnight, when safe assets are redefined. And this is why the most dangerous phrase in times like these is, I'll deal with it later. Later is when choices shrink. Later is when preparation becomes reaction. Later is when people discover that the system they trusted assumed conditions that no longer exist. None of this requires fear. Fear clouds judgment. This requires honesty. An honest look at where value has been moving. An honest assessment of what systems assume perpetual stability, an honest understanding that wealth isn't destroyed in transitions like this. It's transferred. Transferred from those who hold abstractions to those who hold reality, from those who trust indefinite promises to those who demand permanence, from those who react to headlines to those who watch flows. And once you see that, the narrative changes. Gold and silver stop looking like investments and start looking like insurance. Not insurance against volatility, but against systemic fragility. Insurance against the unknown unknowns. Insurance against rule changes that only become obvious after they happen. The uncomfortable truth is that the biggest moves are already behind us in terms of positioning. The whales didn't buy after the headlines. They bought before. That doesn't mean opportunity is gone. It means the nature of the opportunity is different. It's no longer about speculation. It's about alignment. Alignment with assets that don't depend on trust. Alignment with systems that don't require permission. Alignment with history, not forecasts. At the beginning of this story, you heard about one whale buying more gold than 85 countries combined. Now you know there are two, one private, one sovereign, both preparing for a world where gold matters again. where silver becomes critical infrastructure, not an afterthought, where the dollar remains important, but no longer unquestioned. The question isn't whether you were unaware before. Almost everyone was. The question is what you do with awareness now, because awareness is a window, and windows close. Right now, you still have the luxury of time. Time to learn, time to verify, time to think without pressure, time to make decisions when markets are open and shelves are full. That luxury doesn't last forever. It never does. Years from now, people will look back at this period and say it was obvious. They'll point to charts, policies, statements, and wonder how so many missed it. And some will remember this moment and say one of two things. They'll say, I saw it, I prepared, I didn't panic, but I didn't ignore it either. Or they'll say, I assumed someone would warn me when it mattered. This is the warning. Quiet, uncomfortable, unignorable. The music is still playing, but it's fading, and the chairs are already being taken. The only real question left is simple, and it's personal. When it stops, will you still be standing,